So how does the Fed's new approach to data impact you in the market? If you've been watching the headlines, you know the Federal Reserve has been making careful, measured decisions about interest rates. But what's really changed lately is how they make those decisions. In addition to traditional backward-looking data like jobs reports and inflation numbers, the Fed is now increasingly incorporating forward-looking data to guide monetary policy. Here's why that matters for the economy and especially for the real estate market. So what is forward-looking data? Traditionally, the Fed has relied heavily on historical indicators. Things like the unemployment rate from last month, inflation over the last quarter, GDP growth from the previous year. These are important, but they tell us what already happened. In today's fast-moving economy, that often means that the Fed is reacting instead of anticipating. Forward-looking data, on the other hand, includes consumer and business sentiment surveys, financial market forecasts, inflation expectations, yield curves and bond markets, real-time credit usage, and spending behavior. And let's not forget tariffs and how those play a role in the economy. These tools give a more predictive picture of where the economy is headed, not just where it's been. So why does this shift and approach matter? This shift matters because it allows the Fed to be proactive instead of reactive. With inflation still above their 2% target and economic growth slowing, using real-time indicators helps them avoid overcorrecting too late or holding rates higher longer than necessary. For example, if consumer spending begins to slow sharply in real-time data, even before inflation drops, the Fed may consider cutting rates sooner to prevent a recession. So what it means for the real estate market. This forward-looking approach could directly influence mortgage rates if the Fed sees signs of a slowdown ahead before inflation hits the 2% mark. They may cut rates sooner, easing mortgage costs. Buyer activity with better anticipation, the Fed could help stabilize buyer confidence by preventing harsh economic whiplash. And inventory shifts. More stable rate expectations give sellers clarity, potentially loosening tight inventory over time. So as far as investor timing, savvy investors will watch these signals too, timing purchases and sales based on projected economic trends, not just past performance. So the Fed's move toward forward-looking data means that we're entering a more responsive and predictive policy era. And that's good news for anyone planning to make a real estate move in 2025 or 2026. Now more than ever, staying informed and working with a knowledgeable advisor makes a real difference. If you're wondering how these shifts could impact your plans, whether buying, selling, or investing, I'm here to help you think it through with a strategy built for what's coming next, not just what's already happened.